Hey everyone, welcome back to the channel. Today, we're breaking down a really interesting question one of our community members sent me. He shared a gold chart and asked, why didn't gold sell off? That's a great question, and it's one a lot of traders were wondering about last week. So, in this breakdown, we're going to look at what actually happened, how smart money was operating behind the scenes, and what we can learn from it going forward. If you have questions like this too, feel free to email me or drop them in the comments. We might go over them in the next video. Alright, let's get started. Here's the situation. Alex spotted this move and expected a possible sell-off. But there was one key detail he missed. We had an IFVG here, and another FVG right after that. Gold last week was moving really clean. Every leg, every retracement had structure. It was a textbook example of how price delivers when smart money is active. But what exactly did it do, and why did it move that way? When gold was correcting, notice that price never came deep into discount. It would make a small correction, then continue higher almost immediately. Even when it did retrace, it didn't reach a proper discount level, just a shallow pullback before another continuation. So why does price behave like that? Because during stage 2, the market maker is building structure. This is the distribution or manipulation phase, when the algorithm is operating quietly behind the scenes, creating liquidity and preparing for expansion. Now, let's talk about why last week's movement was so clean. This zone here, that's accumulation. You can see the price delivery framework perfectly. Expansion, accumulation, expectation of expansion. Price first makes an expansion, forms an FVG, and then retraces to rebalance that expansion before continuing. That's where we usually look for our entries, during the retracement or reversal phase. Look at this fractal, it's not a simple reversal. Price formed equal highs, meaning the order block that came out of this accumulation caused an expansion that took liquidity above the previous high. That order block is valid. This green candle near the old high made a lower low and a higher high. That makes it a valid breaker. Then, the high of that breaker was broken again with an FVG, and that FVG became strong. I personally took the trade from here to here. Gold respected structure perfectly. It came into discount exactly as expected. Now, why discount? If you draw from this low to this high, you'll see that price reacted right around the 25% discount level. Perfect overlap. That's your swing trading sequence. Expansion, discount, next expansion. That's how the algorithm delivers price during expansion phases. And here's something important. Taking a short trade from the top in a bullish trend is extremely risky. It's always better to wait until price returns to discount before entering. I never take trades that just look like they'll reach discount, because once you're in a trade, your brain gets emotionally attached. And when that happens, your perception changes. You start looking for confirmation of what you want to see, not what's actually true. Basically, your brain starts hallucinating under stress. It's a funny way to put it, but it's real psychology. You might sell, see the market drop a bit, and then ignore the long setup forming right in front of you. You tell yourself, let it drop one more leg, then I'll close the sell. But then the expansion happens, takes your liquidity, and the bigger move to the upside begins, leaving you behind. So what do I do instead? When I see an expansion, I mark it. Then I wait for price to return to discount. When it does, I look for confirmation. That's the sequence again. Expansion, discount, next expansion. Now, let's focus on the most recent move. From this low, where the PD array trade was triggered, expansion started all the way up to this high that took out buy-side liquidity. That's my swing sequence. Just below the discount, there's an IFVG and a bullish FVG. Until the algorithm closes below that zone, invalidates it, or forms a new PD array, I don't consider it a market shift, either short-term nor long-term. So, what happens in the short term? Since the 4-hour swing broke, my DRT shifts to the daily time frame. I move up to the daily, find the next expansion, and say, alright, I'm following this expansion up to the 50% equilibrium level. Notice, price never closed below the FVG. Instead, it started rising again. Because our PD array is based on the 4-hour chart, we drop down to the 15-minute timeframe for confirmation. On the 15-minute chart, here's what we see. A rejection block. Price closed, pulled back to the FVG, and then made another expansion downward. So again, the sequence repeats. Expansion, pullback to FVG, next expansion. Whenever the algorithm trades into an FVG, it's not reversing, it's correcting. That's how the system maintains balance. Since the base timeframe is 4H, we use 15M for confirmation. First, we identify the rejection block, confirmed. Then, there's an FVG that formed before the liquidity grab, right below resistance. It got mitigated perfectly. That FVG gave us 2 reference points, one bullish and one bearish. The bearish one was invalidated, while the bullish one remained valid. That's what makes it an IFVG. Also, this green candle created a lower low and a higher high, closing above its wick. That's a bullish breaker. When the breaker's high was broken and confirmed with another FVG, that FVG became very strong. Just like on the 4-hour timeframe, the same behavior repeated on the 15-minute chart. This is where the next expansion phase begins. That swing low should hold, it's the anchor. Price expands, pulls into the FVG, and moves higher again. That's your entry zone. Enter from the FVG, target the previous high. Then, as price continues, it starts showing signs of returning to discount again. One leg up, and now likely retracing down. You can see this leg. Mark it using the 15-minute DRT. Price taps the 75 level, retraces to the 50, forms another FVG, rises again, closes above the 75 level, and runs the high. Every pip of this sequence has logic. Nothing in this market is random. Now, back to Alex's question. He saw this setup and thought gold was finally going to drop. But those equal highs? They weren't resistance, they were engineered liquidity. Retail traders saw resistance, smart money saw a liquidity pool. Price then dipped below the 4-hour BZ, the balanced candle, which represents a buy-side imbalance and sell-side inefficiency. That means the algorithm only delivered buy-side liquidity there, but the sell-side was incomplete. And where's the incomplete part? Inside the bullish FVG within that BZ. That's why there's logic and reasoning behind every FVG, they're not random gaps. Price tapped into that FVG, traded through it, and then closed higher, confirming it as a valid bullish order block and a bullish breaker. We had a higher high and a higher low, which triggered the reversal and pushed price even higher. Then, from that high to this low, price retraced into discount again and continued to move. What's the target? To take out the previous high and run above it, exactly as before. And this is where many traders get trapped. They study smart money concepts, mark the BOS, FVG, or market structure shifts, and then sell too early, thinking the trend is about to reverse. They sell, see a bit of profit, feel confident, then add to the position, and get stopped out. Then they flip long right after, thinking they were wrong, and the market drops again. This cycle keeps repeating, not because the concepts are wrong, but because they're being applied without understanding the algorithmic context. Here's the key takeaway. When you already know the higher time frame trend is bullish, don't chase price near the top. Wait for it to return to discount, confirm your zone, and only then take your entry. That's how smart money trades. Every expansion, every retracement, every FVG, it all serves a purpose. Nothing is random. So, that's the breakdown of why gold didn't sell off, and how smart money controlled every step of that move. If you found this breakdown helpful, make sure to drop your questions in the comments. We'll review them together in the next video. Thanks for watching, trade smart, stay patient, and I'll see you in the next one.